Good afternoon, and welcome to the Energy Perspectives Group webinar, hosted by InPlay Oil Corporation. This event will be recorded. During the presentation, all participants will be muted. If you have any questions you would like to ask the speaker, please type them into the chat feature. We will read and answer questions at the end of the presentation. Thank you so much for joining us today. Now here is Dan Steffens, who will introduce today's speaker.
Hi, everybody. Thanks for signing on today. We have one of our small cap growth portfolio companies that is hosting today. So it's InPlay Oil Corp. It is a light oil upstream production company based in Calgary, Alberta. And they had an exciting development in the last couple of weeks where they got a $25 million Canadian loan approved, got funded. So they got a new slug of capital that they can get back to drilling and completing wells and start growing their production. Our speaker today is Doug Bartoli. He's InPlay's president and CEO. He has been InPlay's CEO since November of 2012. And prior to InPlay, he was the founder, president, and CEO of Vero Energy, a public oil and gas company from September 2005 to November 2012. And as I recall, that sold at a nice premium. Doug was also previously vice president of operations for True Energy and held management and engineering roles at Husky Energy, Renaissance Energy Limited, and Pan Canadian Petroleum Limited. He was also a director of Invicta Energy and other private companies. Doug is a member of the Association of Professional Engineers in Canada, the Institute of Corporate Directors, and a prior governor of the Canadian Association of Petroleum Producers. So, Doug, it's all yours.
Thanks, Dan. I'm just going to put my face on just for the introduction there, but thanks for that introduction. And I actually am a current member of the Board of Governors of the Canadian Association of Petroleum Producers. So we just had our strategy session a few weeks ago. We had the head of API on a virtual call and had a nice 45-minute discussion with him and trying to work more together. Guys, it's a pleasure to be speaking to you here again today. It's been a while. We haven't marketed since February, of course, with the year we've had, which we've all been part of an experience. We're sitting here with lots of things occurring, and we've actually fared pretty well coming out of this, and I can't wait to tell you our story. So welcome to all you guys down there in Texas. This isn't the way I'd like to be speaking to you. It's nice being in front of you and getting that collaborative discussion that we tend to get going. With that said, with the Zoom call, maybe we get a few more people that haven't heard our story before and want to ask some questions. So welcome to all of you today. So with that said, I'm going to shut off my video here, and I'm going to get right into the presentation because I think we've laid out a pretty good story of what's going on. Oh yeah. Let's see. Okay, so yeah, I mean, we're listed on the Toronto Stock Exchange under the symbols IPO, the OTCQX under IPOOF. Investment highlights. We've changed this a little bit. Who are we? We haven't marketed for so long, we thought we'd have to go back a little bit. We're a technically focused, very strong management team, I believe operating a sound junior light oil and gas company in this challenging environment, while we've been providing top tier growth within our funds flow. Being a junior company has been even exceptionally hard, but we're also positioned in two of the most exciting light oil plays in the Western Canadian Sedimentary Basin. We're in our main play, the highly economic Cardium light oil play, and we have a longer term high impact shale play in the East Basin Duvernay, which we'll talk very little about. But I mean, we've been a consistent top tier organic light oil producer, growth company within our funds flow amongst our peers pre-COVID. We grew 7% over 18, even though we'd reduced our capital budget by 11% and stayed well under our funds flow. In 18, we grew 17% over 2017. Part of our experience is our key is our operational, technical, driven capabilities, driving top quartile capital efficiencies and adding reserves and production. I think our industry's fundamentally changed, and the key to surviving is having those assets and the team that provides you those top quartile capital efficiencies. And why has the industry fundamentally changed? It's changed because we have less access to capital. Both debt and equity are not easily available like they were at one time, and they might never be back. So we have to learn how to live and grow within our means, with our cash flow, just like everybody does in their own lives. And we can do that. But we had a great year finding reserves in the ground, $14 per barrel of reserves. We're averaging the last 3 years, 18,000 a flowing barrel of production adds. Very, very strong numbers. We know what happened with the COVID-19 pandemic. It led to an unprecedented decrease in oil prices as a result of the world oil demand destruction. InPlay reacted quickly on all our controllable options in March of 2020. We halted the 2020 capital program basically immediately. We went through all of our operations and identified uneconomic production resulting in shut-ins and curtailments. We did not want to sell our proved developed producing reserves and our production at a loss. And it's really worked out well for us now. We implemented complete operating and corporate and operating cost reduction initiatives. That resulted in a 25 to 30% reductions. I believe you'll see when things come back, and as they are right now, and there's a little bit of price pressure, it still will result in 10 to 15% reductions. We eliminated all workovers until the third quarter, and we aggressively pursued government programs resulting in about 27 million in liquidity. So first and foremost, we had to get liquidity answered and also to work on sustainability. And that came in the form of a loan from the Business Development Bank of Canada, which provided us with a $25 million second lien 4-year term credit facility. For a small company, these are very difficult to come by. And we're very pleased that we were the first guys to receive that with our hard work that we've done with our lenders and with the BDC. If a small company of our size could actually get one of these, we'd be very lucky to get this with interest rates below 10%. It'd probably be in the 12 to 15% range. So we're in the 6-7% range over the 4-year term. So very, very solid term second lien facility. We started initiating workovers on wells that pay out in 6 to 9 months and started returning curtailed production in the third quarter. Through all this, we were also able to add a very highly intrinsic value acquisition in our focus core area in Pembina. And we are now in position to do more of these. It was done at metrics much superior to what we can do through the drill bit right now. So if you got some cash, these are available. This is a good way to add production and reserves. The intrinsic part is this added to our tier 1 inventory. And we expect to be drilling on this next year, and it's going to be a significant portion of our drilling program over the next 3 to 4 years. So that puts us on the road to recovery. We acted aggressively to get through the pandemic, and I believe we're in an enviable liquidity position right now relative to our peers, with the ability to execute on our recovery and future strategy. We put out some guidances, which is why we are talking here today. It's been too long, but we started our capital program. We started drilling last week. We have a 3-well pad of extended reach horizontal wells in Williston Green. These wells may be on production by the end of the year, but it'll be tight, if not early into January. So what is our strategy? First and foremost, it's to return to pre-COVID production levels as quick as possible and reserve levels. This is expected to occur in the first quarter of 2021. And as I mentioned to Dan before we started, there's very few of my peers that I see us returning to 2019 levels as quick as we are. And then to provide future growth, get back on that track, and free cash flow into an expected commodity price recovery. Overview. So we're going to do about 4,000 BOEs a day with all the curtailments through the second and third quarter. We're drilling 7 wells. 4 were drilled in the first quarter. We've got 3 occurring in this quarter. 4 were in the fourth quarter. 3 are going to be in this fourth quarter. Again, not sure how much we'll get back on. Year-old reserves, I'm pretty sure the price tax will be a lot lower this year, but in general, solid, proved plus probable reserves, very much oil and NGL focused, light oil focused. You can see our market summary. At 20 cents Canadian per share, we got $14 million market cap, $78 million enterprise value. We've actually had really good liquidity through this over the last 6 months. Solid employee and director ownership, and we have some large insider shareholders as well, which I'll talk about on the management and board of directors page. But we ended the third quarter with 61 million drawn on 64 million of net debt. And now our total current credit capacity is about $90 million. So in a really, really strong position, as I said, to get back to those pre-COVID levels and hopefully come out stronger than maybe we went into this if we can take advantage of it properly. Management directors, nothing's changed here. Strong technical team, value creators. All of our bios are in the back of this presentation. They're on our website. And same with our directors. There's been no change in our directors. And two of our directors, Jackie Benton and Craig Olenowski, they represent about 30% of our shares outstanding. So 30% of our shares are represented on our board of directors. The rest are accountants, lawyer, and a geologist running another solid company in Canada. So really industry savvy people. So consistent oil growth. Let's talk about that. We are one of the only companies that has been showing that over the last 4 years within our cash flow. You can see the chart there. Nice consistent growth on a per share basis in the blue dots and the black line. And even in 18, when we sold 250 BOEs a day, we continued to show production growth. Exactly the same with the reserves. We're increasing our reserves every year in all categories. Proved, developed, producing. So that's our producing reserves. That's our straight blowdown look. Our proven, adding a certain amount of undeveloped locations, and our total proved plus probable, adding another level of riskier undeveloped locations. Don't take our word for it. I mean, the National Bank charts that you see here were put out on the left side. That's 2019 over 2018. That's a bunch of our peers. We were the top production per share growth company within our peers. In 2020 over 2019, which they were projecting this year, back in January, again, we were going to be one of the top growth companies. So again, we've been providing that growth. Third parties have also verified that. So solid growth, of course, this year is going to be quite a difference, but we're getting back on track for next year. Reserve highlights, again, it's a year old, a couple pieces there. We are strong produced reserve life indexes that I want to talk about, 4.8 years proved, up to 15 years on a proved plus probable basis. So good, strong, long reserve lives. Again, very efficient at finding barrels of oil and oil equivalent in the ground. You can see we found proved and proved plus probable for just under $8 per barrel, with recycle ratios of 2.9. And we put some of our peers from this public disclosure in the spring beside us. And again, we're doing very, very strong compared to our peers within the Canadian basin here, our light oil weighted peers. So very strong recycle ratios. I mean, the recycle ratios is a oil jargon tool where $1 of capital invested, our finding costs, divided by our netbacks. And if you're providing anywhere north of $2, you're in great shape. Typically anything north of $2, 1.5 times is a good number, but we've been providing better than that. So let's take a look again at our peer group. This is our 2019 results, all pulled from public data in the spring from these companies. On the top left-hand corner, proved, developed, producing reserves. In blue are finding costs, and in orange is the recycle ratio. And you can see us in yellow on the finding costs. So on the proved, developed, producing basis, top left, we're second amongst this peer group. On a proven FDA finding, development, and acquisition costs, we were number one. On approved plus probable, on the bottom right corner, we were number two. And our recycle ratios are solidly in there with that peer group. And we've provided our 3-year averages in finding costs and also capital efficiencies. And again, we're very consistent in adding producing barrels, 18,000 a flowing barrel in 19, which is pretty much exactly equates to our complete full cycle analysis of 18,000 barrels over the past 3 years. First time we put this in, so we got some, our environmental leadership, greenhouse gas emissions on the chart on the top. 2018 over 17, we reduced those emissions by 12%, and then another 25% in 19 over 18. And then with the curtailments, it would have been higher, but with all the curtailments and the things that occurred, it's quite a bit less in 2020 over 2019. We've done things like added environmental we added a vapor recovery unit at our 100% built Williston Green Unit 5 battery. So that's saving from tank ventilation and everything about 460,000 cubes of vented gas since 2019. We basically use pneumatic controls at all of our field sites. No methane is released through any of our control systems, which used to occur lots with the industry. We have a rigorous pipeline integrity program using drones and everything to mitigate risk of environmental impact. We do lots of regular visits along the way. Our asset retirement obligations on the bottom corner. So in green, you can see the amount of money we spend yearly on retiring assets. The purple line is the funds that we're spending against our funds flow. So we are spending the last 2 years, 4.5%, 5% of our funds flow on environmental liability. And if you look at it in the light blue line, that's what we're spending against our inactive liability. So 2.5%, 3%, we're reducing our inactive liability on a yearly basis. And many of that stuff will be operational for upwards of 40 to 50 years. We obtained some money from the Alberta government to help accelerate some rehabilitation. We began a pilot project to start recycling water in our frac operations, and we're very happy to say that we have had no reportable spills or lost time incidents in 2019 or 2020 to date. So this is where we operate. The head office is in Calgary on the Alberta map. On the right-hand side, our Williston Green, Cardium, and our Pembina Cardium fields are in the northwest of us. That's about a 2.5-hour drive. 83% of our production is coming from those fields. The East Basin Duvernay is about an hour and a half drive northeast of Calgary, so just the other way. You can see our 2019 actual productions in the chart and our 2020 production estimates. As I mentioned before, the key to that is we expect to return to those 2019 production levels or very close to that, depending on timing, in Q1 of 2021. And that's part of the mandate with the BDC loan, is try and get there as quick as possible. But you got to manage it within commodity prices. But so far, we're on track to hit those numbers. How do we grow in this environment? The chart shows our declines, our proved developed producing reserve declines from last year in 2020 and 2021. And with our low decline light oil weighted production, high netbacks, and economic quick payout inventory, that's how we've been able to provide that growth that we were showing over the last few years, even in that volatile environment. On the right side, again, just our operating income profit margins is in purple, and the blue dots and the black lines are the changes in WTI price through that time. So we've been continually increasing those operating margins through just strong focus on all of our cost structures. So Williston Green. The yellow is all of our land picture. You can see horizontal wells drilled. It's an old field, lots of vertical wells. That's what the dots are. We are consistently drilling industry pace setter, extended reach 1.5 mile horizontal wells. And our EURs and volumes have been exceeding our forecasts. We drilled 8 5 net in 2019. We've drilled 1 so far in 2020. And as I mentioned, the 3 we are currently drilling. We have lots of locations here. We've been continually exploiting and being leaders in the advancement of completion technologies in here. We're looking at all aspects of that. We're always working on getting better and better. Let's look at the economics here. So a 1 mile well in Willie Green is about 2.3 million. These are half cycle cost to drill, complete, equip, and tie in. A 1.5 is about 3.1 million dollars, sorry. You can see the expected potential EUR recovery, 240,000 barrels to 320,000 on a 1.5 mile well. The type curve is on the right, with the orange being a 1.5 and the blue being 1 mile. When you go to the bottom, and let's just stick with $40 WTI today. On the 1 mile wells, we get about 1.7 year payout, just under a 50% internal rate of return. As you would expect with an extended reach well, accessing more reservoir, a little more drilling efficiencies and capital efficiencies, we're about 1.1 years and just under 100% rate of return at $40. Break evens, you can see on the bottom, at 10% internal rate of return, it's $27 WTI for a 1 mile well, and it's $22 WTI for a 1.5 mile well. Pembina, this has been kind of where we pulled away from here for a little while, but we've now come back. We have now drilled 6 wells in the last year, and we are again drilling industry pace setter 1 mile horizontal wells, and our volumes are exceeding our forecasts. In Q4 of 19, we drilled 3 net. In Q1 of 19, we drilled another 3 100% wells. We've got 150 locations here. You can see our new acquisition in the blue in the furthest southwest corner of that land map. Great facilities and infrastructure we have in here. The chart on the left in the middle, the dark blue line is our type curve, our forecasted type curve, and you can see our well results exceptionally exceeding that type curve. You can see the dips in there. That's when we curtailed through the second quarter and into the third quarter. But all those wells are now coming back online and well above the type curves, and we did not sell a whole bunch of it at the lowest of the commodity prices. 1 mile wells, $1.7 million. 1.5 mile wells, $2.3 million. And you can see the recoverable reserves estimated at 160,000 and 230,000 for a 1.5 mile well. And the type curve on the far right in orange, one for a 1.5, and blue for a 1 mile well. So let's look at the economics. Stick with the $40 scenario. Payout 1.7 years, 52% IRR on a 1 mile well. 1.5 mile well, payout 1.6 years, and about a 60% internal rate of return. Break-even costs on these scenarios of $26 to $24. We haven't drilled a 1.5 mile well here yet, so I can't wait to start doing that, which I expect will happen in the first quarter. And I think we can actually do better, but this is our early internal estimates here. Let's talk about the highlights of this recent acquisition and why it's so important. First and foremost, we cannot add light oil production and reserves through the drill bit at the metrics of this. But most importantly, the inventory it brings to the table is spectacular. We spent $1.9 million net of adjustments. We'll have to do a few final adjustments, but give or take, that's what it's going to be. We had the external third-party reserve report at year end on this property was approximately 1 million barrels, just adjusted for production. It was higher than 1 million barrels. We added PDP reserves at $1.90, so under $2 per BOE. If you look at our sheets prior, and maybe I'll just rip back there quick. If you look at our finding and development costs on a proven basis at $40 is around $10 per barrel. Again, we can't add production at $1.90 per barrel through the drill bit. Strong reserve life index here, very low decline area. 240 barrels with a 10% decline. So again, we added production at 8,000 a flowing barrel. We're typically adding corporately at 18,000 on a full cycle scale. This asset we bought for 1 times 2019 net operating income. You can see the contiguous land block. It allows for a lot of extended reach horizontal wells and also significant potential drilling upside. 30 locations, but 23 of those locations we consider tier 1 that competes with our current inventory. This is 100% working interest crown land, so government land, typically easier to deal with sometimes. This allows for full scale development at a pace entirely within our control. And we plan to start drilling on this acquisition in pretty much in the first quarter of 2021 if we stay in this $40 pricing environment. Why do we love it? If you look at that red circle, there's 3 wells that surround our lands. There's and these are 1 mile horizontal wells. There's our Pembina 1 mile type curve, and it's production over time on a cum oil basis. You can see well 2 and 3 are over that basis within the first year, in the first 6 months, 180 days. But well number 1 is pretty close to the best Cardium horizontal well in Pembina. The economic ultimate recoverable reserves looks to be about 385,000 barrels of oil and 540,000 BOEs of total reserves. Spectacular numbers. And this, again, taking our drilling and our completion technology into consideration, what we learned in Willie Green, bringing it to Pembina, what we've done with the last 6 wells. You can see our logo here. We have now drilled the 3 fastest wells, 1 mile wells in Pembina ever. We've got 5 of the top 9 fastest 1 mile wells in Pembina. And our last one over here puts us at 6 in the top 33 fastest wells by industry of all time. So little old InPlay Oil, again, kicking some perennial butt on this play. The Duvernay, you know, we're in the Huxley area of the Duvernay Basin. You can see our land in yellow on the map. There's another area with a few more wells drilled in Joffrey, again drilled by a private company that is 52% owned by the same shareholders that own around 30% of us. So good technical experience in this play. We got just under 50 crown sections of land here. So a section of land, 640 acres or 1 square mile by 1 square mile. Lots of locations potentially here. We haven't had a lot of focus on this for a while. I think the key will be, you know, just to ensure that we try and maintain as much land as possible until we get a return in oil price, and we'll still look for some partners here. And you've seen this before, whoever has seen us present, and the 1 of 11 well was one of the first wells drilled in the Huxley area. Looks like it'll do 275,000 barrels of oil, but you know, a pretty long payout. Early completion technology. You can see the wells over time getting better and better as the completion technology changes, where you have wells at IP at 50 or 500 to 600 BOEs a day. 2 of 26 is a well that is splitting 2 sections of our land. So it's about a quarter of a mile from one section and 3/4 of a mile from another section. It looks like to be one of the best wells in the Willie Green area. It's a 1.7 mile well that looks to be able to do somewhere north of 600,000 barrels of potential recoverable reserves. I mean, economics, you know, we brought this down. There's no use going to $40, but at 50, 60, you can see the economics. Development capital, $4.5 million for 1 mile, 5.5 for 1.5, 6.5 for a 2 mile well. You would expect higher IPs and more recoverable reserves. That's why we put that black line through the middle there, or that black staggered line showing about the NPV and the IRR. It looks much better at 60. It looks even better at $70 WTI. The key to some of this is because it's crown land, we're typically going to get 5% royalty for anywhere from 4 to 6 years on this play. Completely different than what you see in the Permian and many of the US shale plays where you got to pay 25% royalties for the life of the well. So we get 5% for the first 4 to 6 years. So it helps significantly with the economics, but it doesn't compete with the economics in the Cardium play. So, I mean, one thing we'll look here when things return, it would be nice, you know, to find some partners and to help develop this play a little bit quicker. But we need some different changes in pricing for that to occur. In summary, you've got a strong team here managing a very sound, flexible, focused company in an extremely challenging environment. We're very solid technically. We're very capital efficient. We had aggressive and effective response to the unprecedented environment as a result of COVID-19. The actions the team have taken have put us in a solid position on the road to recovery. I think it's an enviable position against many of our junior peers. Our plans are to quickly return to pre-COVID production and reserve levels. I've had this in here for a while, and obviously with the volatility in commodity prices, we are built for sustainability and financial viability. It's been very difficult, but we've seemed to have worked our way through it now. Again, we've been providing top decile organic growth per share on light oil production since before pre-COVID. We are positioned for more of these acquisitions, and we'll take advantage of it if it makes sense here. And hopefully, like I said, come out stronger in out of the first quarter and into the second half of 2020 when, as you know, Dan, and many people think that the pricing is going to turn nicely for us. I've said this for a while, but it really means something now. We have significant torque to the upside with the oil pricing. And I'm just going to go back to our strategy. We want to return to pre-COVID production and reserve levels, which we expect to do in the first quarter of 2021 if pricing stays where it is, and then get back to providing future growth and free cash flow, especially for a little while, to pay down debt into an expected commodity price recovery. Now, with that said, I am going to be here to answer questions as long as anybody wants, and I look forward to that discussion.
Great. Good presentation, Doug. I just want to remind everybody, if you would like to ask a question, just go to the bottom of your screen in the center of it. Just take your cursor down there and click on the chat feature, and you will type it in. Then I will read the questions to Doug. But I've got a few questions here. Okay, Doug, on this Canadian loan that you just got, the 25 million, does any of that money have to go to the other debt holders? Are they, clamoring to pull out some of the money, or can you use all of that for drilling and development?
Yeah, great question, Dan. So the answer to that is, it provides us with strong liquidity to get back to those pre-COVID levels. We don't want to use all of it unless it makes a lot of sense potentially for a acquisition that is significantly below PDP lending levels. But realistically in a forecast, our net debt will go up in the next little while, but we still want to remain some liquidity in there to get back to those levels. But that debt starts decreasing in the second half of the year on strip pricing, when if the pricing continues to move up and as it shows in the strip. So you'll start seeing that debt come back down. But initially we'll bump it up a little bit, but we still want to remain some liquidity and give us some room. You just got to manage through the volatility and some of the ups and downs that occur here through all of this. So that's kind of the key on that front.
Okay, on the 3 wells that you're drilling right now from that new pad, are you going to drill them all first and then complete them all at the same time?
That is correct. Okay. That's part of our cost structures is the assembly line piece. And I can say right now we are on track on our first well to set a new record on drill times. It's funny about sometimes when you have that time off, you get a little chance to reset, think things through differently, and act on it, and that's what we've done. So, but yeah, to get that capital efficiencies, it's very difficult to do on one-off. So we're doing it on a lot more, assembly line type basis.
Yeah, well, we found down here that some of the companies in the Permian, they would drill one well to hold like 2 sections, with the idea to, just hold as much land as they could and then come back and do a bunch of development wells. But then when they came back, a year and a half, 2 years later, the offset development wells, because they had lowered the pressure so much, were not getting nearly as much, the results they expected. So the idea now is to drill all the wells you can, then complete them all at one time, and you get a better total recovery, I think. So anyway.
That's a great point, Dan. You're totally right. The longer you wait, you've depleted pressure and it hurts. So once we start on a pad, once we start in an area, we want to completely drill it fully and right. get all the production, starting at the same time. It's kind of interesting too, right? We put a fair chunk of water down, so you got an instantaneous water flood, right off the hop as well. Like you're putting you're pressuring up, a half a mile area on a 3-well pad with a lot of water right away. So that helps with the initial pressure maintenance.